Opendoor delayed reverse split. Will it start a short squeeze? Opendoor Technologies, Open, delaying a reverse stock split might increase short squeeze speculation, but it's unlikely to trigger a true short squeeze by itself. Let's break this down. Key facts. Reverse split delay. Reverse splits are often seen as a way to stay compliant with listing rules, e.g., Nasdaq's $1 minimum. Delaying it could signal confidence from management or an attempt to avoid negative sentiment that usually follows reverse splits. Short interest. As of late July 2025, short interest on Open remains elevated, 20-25% afloat, which is high, but not extreme, e.g., greater than 40%, like classic short squeezes, e.g., GME, AMC. Retail sentiment. Open has some speculative retail following, but not nearly the same crowd movement or cult-like backing that helps fuel a squeeze. Will this trigger a short squeeze? Unlikely on its own. A short squeeze needs high short interest. Open checks this box moderately. Positive catalysts or surprises, like earnings beats, acquisition news, or housing rebound. Limited float and strong buying pressure, e.g., from retail traders or institutions. A reverse split delay could help temporarily boost sentiment. They believe a turnaround is coming. Stall technical breakdowns. But it's not a squeeze catalyst by itself. What would increase squeeze potential? Surprise profit or revenue beat. Improved housing market data. Institutional buy-in or insider buying. Upbeat forward guidance. Bottom line. Delaying the reverse split might support the stock price in the short term. Reduce downward technical pressure. Create some speculative buzz. But it's not strong enough to start a real short squeeze without fundamental or speculative catalysts. Short interest and borrow rate summary. Short interest, as of June 30, 2025, 135.8 million shares sold short. This represents roughly 19% of the public float. Short interest asterisk appears to have declined from prior levels, 21-22%. Days to cover, short interest ratio about 1.8 trading days, based on average 208 million daily volume. Note, latest official short interest data is bi-monthly and through June 30, 2025. Borrow fee rate and availability, as of July 29, 2025. Borrow cost, annualized APR, 10.36%, with recent trading day high between 10.29% to 11.01% depending on timestamp. Shares available to borrow, around 4.2 million. Note rapid fluctuations over prior days. What it means for a potential short squeeze. Conditions that support a squeeze. Factor status. High short interest, 19-22% afloat. Low days to cover, 1.5-1.8 days. High borrow cost, 10% APR. Retail/social buzz elevated via meme stock channels. These typically create a setup where any upward price pressure might force short sellers to cover quickly, amplifying the move. Limitations and risks. Short interest is high but not extreme, not at 40-50% levels seen in iconic squeezes. Despite active retail sentiment, no sustained fundamental catalysts, e.g., earnings beat, housing rebound. Yet, borrow availability is modest for million shares, but not unusually constrained. A gamma squeeze via options flow may provide transient upside, but brace for high volatility. Squeeze likelihood. On its own, the current borrow costs and short interest create a speculative setup, especially amid retail enthusiasm. However, without a strong fundamental or coordinated retail surge, it's unlikely to evolve into a full-blown short squeeze like GameStop or AMC. Final verdict. Short interest, 19% of float, 135.8 M shares. Days to cover, 1.7, 1.8. Borrow rate, 10.3, 10.4% APR. Available shares to short, for 0.2 M, volatile. Market context, meme stock style frenzy, but no broad institutional overhaul or breakout earnings. Squeeze potential, elevated risk in the very short term, especially if a catalyst emerges, but no guarantee of a sustained upward spiral.